Inversion fair value gaps are an ICT concept that have become recently popular because of how well they work with other PD arrays and their insanely high win rate. I use inversion fair value gaps as one of my primary entry strategies, and I'm going to share with you the step-by-step guide to qualifying an inversion setup in this video. Understanding the strategy is just half of the equation. The other half is avoiding the beginner mistakes new traders make when trying to use this model. So I'm going to share with you the 5 biggest mistakes I see traders make to give you a huge head start in becoming profitable. But first, if you have not watched this video about fair value gaps and you don't know how they work, you need to watch this to lay the foundation. Also, I live stream most days of the week while I trade the NASDAQ, and I would love for you to join us right here on YouTube at 9:20 a.m. Eastern Standard Time. And with that, let's get into the video. An inversion fair value gap, or an IFVG for short, is basically a fair value gap that has been violated. Here we have a fair value gap. As soon as a candle closes above this fair value gap, violating it, it turns into an IFVG. Now, we assume when a fair value gap is violated that price wants to start moving in the opposite direction and begin to run towards an imbalance or liquidity. If we play this out, we can see price ends up running higher into that swing high here and ultimately running this swing high right here. Now, the elements of an FIVG is identical to a fair value gap, just used in the opposite way. The areas that we want to identify are the high of the fair value gap, the low of the fair value gap, and the middle of the fair value gap, which is what we call the consequent encroachment. Take a look at this fair value gap right here. Just like we expect a fair value gap to operate, it comes up into the fair value gap, respecting the upper half of the fair value gap, not going into it. When we want to see lower prices, we want it to stop in the lower half ideally and then move lower. It can wick up into here, it can close into here, but ideally we want to stay in the lower half. For an IFVG, it is the same way, and for moving forward, I'm going to refer to both of these as fair value gaps, but understand that when we close above an FIVG, we want to use it in the opposite direction. We want to see it close through it and then respect the upper half of this fair value gap and then continue higher, just as we see here. This is how we read order flow. As we see price move the other direction, it changes the order flow. How do we know that? Our first indication is we violated this fair value gap right here. The same way we use confluences or overlapping PD arrays with fair value gaps, we use in the same way with inversion fair value gaps. As we take a look at this section of price action, we have a list of criteria that we need to go through if we want to use this inversion strategy. So number 1, we want to wait for liquidity to be purged. This is our purge on liquidity. As we wait for price to run this low, we now go to step 2. Identify a single fair value gap in the price leg. Well, in this price leg, we have 3. 1, 2, 3. We have 2 options to consider moving forward at this point. We can move up to a higher time frame to see if we can consolidate these multiple fair value gaps into a single fair value gap in this leg, or we can consider using the highest fair value gap. But in this specific instance, we are sitting on the 5-minute time frame, which is the absolute highest time frame I'm willing to use this inversion strategy on. Ideally, I'm looking at the 30-second, the 1-minute, 2-minute, and then you have the 3, 4, and 5-minute. So because we're on the 5-minute time frame, I cannot go up in time frames to consolidate this. I'm going to have to look at the highest one. So let's go on to step number 3. We want to find a bullish candle that violates this fair value gap with a close above the fair value gap. We get that right here. As soon as this closes above, it turns this fair value gap into an IFVG, and that is the entry point for our model. Number 4 is you enter your long position with a clear swing high above it, or a swing low if you're going short. So we would be going long right here, as you can see, and we would want to move our stop to the low of that fair value gap that we just violated. Now, as price moves up and down, we do not want to close our position unless the candle closes, not wicks through, but closes below the violated fair value gap. That's this fair value gap right here. We then would be targeting our first swing high, which is right here. That is 17.5 candles that you could target on the close of that candle. Now, if you believe we're really bullish and you think we might run this high and then this high like we do in this example, we move on to step 5. We want to move our stop to break even when the internal or the external high is hit. In this case, this would be an internal swing high. So would this one, but this is the higher internal swing high that we may actually target when price starts moving. As price begins to move, we want to actually move our stop to break even the moment this swing high is hit right here. We have our target hit right here, so our stop loss would now be moved to break even. Why? This is to protect you in case price wants to reverse, because after price hits a swing high, there's a tendency for price to start moving in the other direction. Just take a look at this candle. It moved aggressively higher and then closed bearish below our break-even point. So in this instance, we would have hit our first target, but we would not have hit our second target. Why? Because we moved our stop to break even, which is step number 5. And that goes on to step number 6. If we would not have hit this low and we would not have hit our break even, we would still be in a position if we had multiple contracts. And then we could leave a runner for that larger move. Let's take a look at another example in my favorite time frame, the 1 minute time frame. Here we have a swing low, and that is our first indication that price may begin to move in another direction. As we begin to see this play out, we are waiting for the inversion of this fair value gap because it's the singular fair value gap in this price leg. Where's the price leg? From this high to this low. Now that we know that, we're waiting for it to be violated. As we see here, price violates this fair value gap, and now we can target this swing high. So let's take 2 positions, and our initial target is going to be this swing high sitting right here. As price begins to play out, we make equal highs. We actually don't break that swing high. So therefore, we're not moving our stop to break even. Our stop is going to be here at this low. So let's let price play out a little bit more here. We don't hit our stops, but we hit our first take profit. So we're going to take 1 contract off right here. And now let's see if we can target our next TP, which is going to be this swing high right here for 50 handles. Price then would have stopped us out because we hit our first TP and we would have moved our stop to break even, and we would have been stopped out right here at the 1537 candle. Let's look at another example. As price begins to play out, we see this key level that was ran right here. We're now waiting for price to begin to move in the other direction. Firstly, we would be looking at this candle right here. As we play this out, we see price does not actually close below this fair value gap. Instead, it actually closes above this fair value gap. This would not be an entry you would want to take. We already ran our key level, our swing high. We're not looking for longs at this point, we're looking for shorts. As we play this out further, let's see what happens with price. We immediately get another inversion fair value gap running the other direction. We see the close right here. Now, because we understand we hit this key level here and we closed below a fair value gap, this is an entry that we could potentially take. We have this swing low and the swing high sitting right here, and guess what? This is the only single fair value gap in this price leg, so this would qualify as an entry. We're not going to target this low. This is an internal swing low where we're going to move our stop to break even, but our target is going to be this tiny swing low sitting right here. So as we play this out and we make our entry right here. We move our stop to the high of the inversion fair value gap, and then we are going to take our profit here. Now we're going to move our stop to break even when this level is hit right here, but ultimately this is our target. Let's have this play out, and boom. On the next candle, halfway through this candle, we would have moved our stop to break even. And now we are waiting for this level to be hit. And it's so important that you make sure you take your profit, because this may reverse. Let's just play this out and see what happens. Price actually runs the other direction. Now that we got a good understanding of how to use the inversion model, let's talk about the 5 mistakes that you want to make sure to avoid when using this model in your own trading. Let's begin with number 1. Number 1 is to make sure that you do not use this model when you're in consolidation, because it's less consistent. Let me show you. If you look at this price action right here, this is considered consolidation. We're not going very high, we're not going very low. However, we do sweep this level right here, and then we start to reverse, inversing this fair value gap right here. But as you can see, we close below it right there, but decide to run the other direction. And this can happen a lot in consolidation. The moves are so muted and small. It's just something that you want to stay away from, and it's going to take time to be able to identify when you're in consolidation and when you're just ranging. Mistake number 2 is taking a trade before news. This is something you just want to avoid, because before news you can get all kinds of manipulation. You can get inversions that don't respect, and they tend to run the other direction. Fair value gaps that are violated constantly. So to protect yourself and your profits, do not take a trade before news, typically 30 minutes to an hour before news. But overall, you're going to want to wait until after the news takes place, let it play out, and then begin to look for your entry. Mistake number 3 that new traders make when using this model is not rotating between the time frames when you're looking for this model. So right here we have the 1 minute time frame, and as you can see, we have the violation of a fair value gap sitting right here, but it runs this low right here. But if we look at the 3 minute, we have a 3 minute that looks a little bit better. It violates this inversion fair value gap, it runs lower, and here's our swing low right here. Making this mistake will cause you to miss out on opportunities or trades that look better on specific time frames. And this kind of goes into mistake number 4, and that is using higher time frames for this model. Do not use the 15-minute time frame or higher to take an entry for this model. Ideally, you want to use the 15-minute to find out the direction or the narrative of the market, and then zoom down into a 1 minute time frame to laser in on your entry using the inversion model. And mistake number 5 is when new traders take the inversion model when there's equal lows below or equal highs above. Right here we have 2 relatively equal lows. When we have this, it does not matter if you have a great inversion gap to the upside, don't take it. Avoid going against equal lows and equal highs, because these equal lows and equal highs will turn into great draws on liquidity. Here's 2 equal highs right here, and what do? We end up hitting them. I would not have taken it because we had these equal lows. It sets you up for the better move right here to target those equal lows. If you were to go down to the 30-second, you would be able to see this play out perfectly. Here's the 30-second right there. The close below would be right here, giving you an opportunity to run for these equal lows right here. If you're liking this video, check out these videos right here, which is a part of our Essential Trader series, which goes over the basics of all the ICT concepts. You will be able to save a ton of time going through those videos. Thanks for watching. We'll see you in the next video. Take care.